Michael Burry's advantage was he wasn't part of the collective. He was just this guy in a t-shirt and shorts with a glass eyeball and Asperger's syndrome, looking at the numbers when nobody else really was.
Welcome back to Investment Tribe, where you've subscribed because you want to learn and generate money from cryptocurrency and other digital assets. Don't forget to leave us a thumbs up and enable the notifications so you'll be alerted when we post a new video. Also, don't skip any parts of this so that you don't miss out on important details. And if you have any questions or recommendations, please share them in the comments section below. For today's video, we're gonna talk about the man considered a legend in the financial world, Michael Burry. Burry predicted not only the dot-com bubble, the 2008 recession, but also the rise of GameStop. He made millions, even billions for his company by just betting on these predictions. Now he's back with another prediction. He believes that the biggest market crash in US history is going to happen soon, and he's betting millions on it again. If he's right, the stock and crypto market would fall as much as 95%. And with this track record, we need to take this very seriously. So, we will talk about why Burry is betting again on the market crashing. Michael Burry is different than any other market crash predictor because he's so confident in his predictions that he is willing to lose hundreds of millions of dollars. From 2000 to the first quarter of 2008, he averaged a return of 28.6% per year for his investors. That's remarkable. And if you think he just got very lucky, well, since the start of 2016, he returned on average 22.8% to his investors at his new fund Zion Asset Management. So even if you're skeptical, you still got to at least listen to what Burry has to say. This man has an outstanding investing track record. But large institutions and powerful world leaders are still trying to silence Burry. After the SEC started looking into him, his Twitter account got deleted. This included all of his unprecedented warnings. It just makes sense that governments and corporations are keeping Burry's mouth shut because he's not predicting a market crash, but possibly the collapse of America. He believes that almost all markets will collapse: cryptocurrencies, gold, stocks, real estate, bonds, and many more. Burry's massive bets are based on the upcoming inflation in the US dollar. He said in a tweet that the US government is inviting inflation with its MMT-tinged policies, brisk debt GDP, M2 increases while retail sales, PMI stage 5 recovery, trillions more stimulus and reopening to boost demand as employee and supply chain costs skyrocket. A lot of technical jargon, but we will try to analyze this little by little. Burry argued that modern monetary theory, or MMT, has devastating effects on the economy. But what is MMT? Basically, it's a macroeconomic theory that states that governments should borrow or print money until their economy reaches full employment, meaning governments should increase the monetary reserves until the unemployment rate reaches normalcy. It makes sense on paper, but there are major concerns about this concept. First, US debt as a percentage of GDP is at its all-time high. Second, M2, which is the total amount of money supply, is at its highest too. The constant money printing and borrowing are happening at the same time. Businesses are already recovering. We can prove this recovery by looking at Purchasing Managers Index, or PMI. This tracks the current conditions of business, whether good or bad. And as you can see, the current index even exceeded the levels before pandemic. That is why it is kind of a shock that the US government is still printing more money despite this. Consumer prices are already up as well, and supply chains are falling to meet demand. Michael Burry compared this current state to the US market in 1920s Germany, where it experienced hyperinflation. Germany businesses and the stock market were booming at the time, and prices were steady. The German mark, which is the currency of the country at that time, even became the strongest currency globally for a short period. This is exactly what's happening with the US right now. Going back to 1920s Germany, the crime rate soared around that time also since only wealthy people had access to easy money investments, so poor people had to resort to illegal activities just to get in. It became very easy for German businesses to make money. Failures and bankruptcies became very rare. Even the non-essential businesses boomed during the time. So it made sense that everyone wants in. It even led to a point where German brokers are so backlogged with the trading papers that they had to occasionally close down just to keep up. But the problem is this was all speculative. It added nothing to Germany's wealth, and it is very similar to what's happening with the US today. Assets are very speculative right now. Burry even claimed that we are currently in the greatest speculative bubble of all time in all things by 2 orders of magnitude. When this bubble collapsed, Burry warns us of its massive consequences. Again, he looked at what happened to Germany. All the German marks that existed in summer of 1922 were not even enough to buy a single newspaper or a train ticket in November of 1923. But much of the loss by Germans happened much earlier. They just didn't know it at that time. Germany's inflation cycle ran over 9 years. It built up throughout those 9 years, and the collapse happened in just a year. This thought is very frightening, but there is still a bit of hope. Some investors might tell you that the best way to prepare for inflation is to invest in inflation-protected assets like real estate, diamonds, gold, commodities, and even collectibles. But Burry thinks differently. He said that investing in these assets would be stubborn. Historically, it might work, but Burry claims that the modern hyperinflation might be somewhat different. He feared that in times of crisis, the government will try to control everyone's assets. He added that governments will squash competitors in the currency arena during a crisis. But you might think that Bitcoin and other cryptocurrencies are safe because the very essence of it is that it's decentralized, meaning it cannot be controlled by the government. Burry thinks otherwise. He sees a bigger problem with Bitcoin. He believes that it will likely not be sustainable because of the massive amount of leveraging with it. A small dip in price could lead to a huge downward spiral. It would be a never-ending cycle because when one investor loses money, they will get margin called, causing prices to fall. And when prices fall, this will lead to other investors to get margin called, and so on. This will continue until everyone's margin called. If you do not know how much leverage is involved in the run-up of crypto, you may not know enough to own it, said Burry. As paranoid as it sounds, Burry thinks that everything will be negatively impacted. He even compared the fads today, like Bitcoin, EVs, software as a service, and meme stocks to housing in 2007 and the fiber, dot-com, and routers in 1999. They are all driven by speculative fervor in insane heights, and it will be massive and painful when it falls. So the main question now is, where should we invest? As I said, there is still hope in this impending doom. We will look at Burry's massive moves in his portfolio and maybe learn something from it. But before that, we need to learn 4 important concepts to understand with inflation: capital costs, input costs, pricing power, and interest rates. Let's understand these 4 concepts because this is essential in surviving during an inflationary period. Capital costs are the one-time expenses that are used to manufacture a product or service, while input costs are recurring expenses used to create a product or service. So during inflation, the goal is to invest in companies that maximize capital costs and minimize input costs. A great example of this, according to Warren Buffett, is a tall bridge, because you already built it using the capital cost and you don't have to keep replacing it, so input costs are minimal. It is sustainable because people will still go through toll bridges even the price increases, unlike businesses like General Motors, where the people may stop buying it if the price doubles. Also, auto manufacturing companies have high input costs, especially during inflation times, so it will not be profitable. The next factor is pricing power. This is the company's ability to raise prices without losing business to a competitor. Buffett said that this is the single most important decision in evaluating a business. The 4th and last factor is interest rates. Frequent borrowers will still be borrowing even though interest rates are incredibly high. Higher loan rates are devastating to borrowers because of the increased cost of capital. With this in mind, let's look at Michael Burry's portfolio. They are divided into put options and call options. Put options are contracts betting that a stock will fall, while call options are contracts betting that the stock will rise. Burry's largest position in put options is Tesla, which covers more than $731 million worth of stocks, or a 34% increase from the prior quarter. He also has put options on some exchange-traded funds, or ETFs. First is the iShares 20-plus year Treasury Bond ETF, which covers $280 million, an increase of 53% from the previous quarter, and ARK Investment Innovation ETF, which is worth $30 million of funds. As for his call options, Burry's two biggest stocks are Facebook and Google. The former covered $327 million, which is a 71% increase, while the latter covered $230 million, which are only 14%. His other call options included $130 million on McKesson Corporation, $58 million on Kraft Heinz, $53 million on Walmart, $48 million on Cardinal Health, $43 million on CVS, and $9 million of a fund that shorts treasury bonds. These are the ones that are disclosed in his option contracts, but some premium contracts are undisclosed to the public. These options can be boiled down to three things: inflation hedges, growth stocks, and bond market. For inflation hedges, all of his options are companies that require minimal input costs. That, for example, Facebook and Google. People will still use these apps even if there's inflation. As a result of this, these companies have pricing power over their advertisers. As for the growth stocks, Burry is betting on higher interest rates. Growing companies will be the most affected by increasing interest rates. That's why Burry betted against companies like Tesla and ARK Invest Innovation ETF. And lastly, for bond markets, as the interest rate increase, bond yields must go up too. And when it increases, bond prices must go down. That's why he bought put options on a bond ETF and bought a call option to a fund that shorts treasury bonds. So what are your thoughts about this? Let me know in the comments down below. If Michael Burry happens to be right again, then this might become a single most devastating, catastrophic event in the financial world, and he might be featured again for The Big Short too. Well, that's all for now. As usual, this is Investment Tribe. See you again tomorrow. Keep in mind to like, share, and subscribe to the video.